Tax time 2026 is almost here, and every year, millions of Australians lodge their tax return and leave money on the table. Not because they're dishonest, not because they're doing anything wrong, but simply because they don't understand how the system actually works. In this video, we're going to change that. We'll walk you through exactly how the Australian tax return works for the 2025 to 26 financial year, what deductions are available, and the most common mistakes that cost Australians money every single year. No jargon, no complicated formulas, just clear, simple information so you can head into tax time 2026 confident and prepared. Let's get into it. First, how does the Australian tax system actually work? Most Australian employees pay tax throughout the year via a system called Pay-As-You-Go, or PAYG withholding. Every time your employer pays your salary, they withhold a portion of it and send it directly to the Australian Taxation Office, the ATO. The Australian financial year runs from the 1st of July to the 30th of June. So the 2025 to 26 financial year covers the 1st of July 2025 through to the 30th of June 2026. At the end of that period, you lodge a tax return. Think of it as a reconciliation. You're telling the ATO exactly what you earned, what deductions you're entitled to, and what tax you should have paid. If your employer withheld too much throughout the year, you get a refund. If they didn't withhold enough, you owe the ATO the difference. A properly lodged tax return makes sure you're paying exactly what you owe, not a cent more. The 2025 to 26 financial year ends on the 30th of June 2026. From the 1st of July 2026, you can begin lodging your tax return for that year. The deadline to lodge your own return, if you're doing it yourself through myTax, is the 31st of October 2026. That gives you 4 months from the end of the financial year. If you use a registered tax agent, they typically have extended deadlines, sometimes well into 2027, which is one advantage of going to a professional if your situation is complex. One important tip for 2026, don't rush to lodge on July 1st. Wait until late July at the earliest. Your employer, bank, and other institutions need time to submit their data to the ATO. If you lodge too early, some income and interest information may not be pre-filled yet, which increases the chance of errors. The ATO themselves recommend waiting until late July before lodging. There are 2 main ways to lodge your 2025 to 26 tax return. The first is myTax, the ATO's free online lodgement system, accessed through your MyGov account at my.gov.au. It's free, step-by-step guided, and automatically pre-fills a lot of your information from the ATO's records. For most Australians with a single job and straightforward finances, myTax is perfectly adequate. The second option is using a registered tax agent. These are professionals, accountants, tax agents, firms like H&R Block or eTax who lodge on your behalf. They charge a fee, but that fee is itself tax deductible the following year. A tax agent is worth considering if you have multiple income sources, an investment property, a complex work situation, or if you're simply not confident doing it yourself. Which is right for you comes down to your situation. Simple finances, myTax is fine. Complex finances, a registered tax agent earns their fee. Either way, lodge every year on time. The ATO may apply failure to lodge penalties if you lodge late without an approved reason. Now let's talk about deductions, because this is where most Australians either miss out or make mistakes. A tax deduction reduces your taxable income. Lower taxable income means less tax and a bigger refund. Here are the main deduction categories available to everyday Australians for the 2025 to 26 year. Work-related expenses. If you spend your own money on something that directly relates to earning your income and your employer doesn't reimburse you, it may be deductible. This includes uniforms or protective clothing required specifically for your job, tools and equipment you purchase for work use, and self-education expenses where the study directly relates to your current role. The key rule: The expense must directly relate to earning your income, not just generally improve your career prospects. Working from home. If you worked from home during the 2025 to 26 financial year, you may be able to claim a deduction for the additional cost you incur. The ATO's fixed rate is currently 70 cents per hour. Check ATO for latest rate for every hour you worked from home. This covers electricity, gas, internet, phone usage, and stationery, all bundled into that single rate. You cannot claim those items separately on top. Important, you must keep a record of the actual hours you worked from home for the entire financial year. A timesheet, roster, diary, or spreadsheet all work. You must keep a record of hours worked. Estimates without supporting records are not accepted. You can separately claim the depreciation of equipment like a work laptop or office chair on top of the 70 cents rate. Those aren't included in the hourly figure. Vehicle and travel expenses. If you use your own car for work-related travel, visiting clients, traveling between job sites, or attending work locations, you may be able to claim a deduction. Note, your regular commute from home to your usual workplace is not claimable. The ATO rate is currently 88 cents per kilometer. Check current rate for your year, up to a maximum of 5,000 business kilometers per year. This rate covers all your car running costs, fuel, insurance, registration, servicing, and depreciation, so you can't claim those expenses separately on top. You don't need receipts for individual car expenses under this method, but you do need records showing how you calculated your business kilometers. A diary or logbook works well. Investment-related expenses. If you have investments, shares, managed funds, or an investment property, certain costs related to managing those investments may be deductible. Things like account keeping fees, interest on investment loans, and the costs of managing a rental property can all potentially be claimed. Charitable donations. Donations to registered Australian charities, called deductible gift recipients or DGRs, are tax deductible provided you have a receipt and the donation is $2 or more. The golden rule for all deductions: you must have spent the money yourself. It must directly relate to earning your income, and you must have a record, usually a receipt or bank statement. The ATO has become increasingly sophisticated at identifying claims that don't hold up. Claim what you're genuinely entitled to. Nothing more, nothing less. Now the mistakes, and these are what cost Australians money every single year. Mistake 1. Not lodging at all. Some Australians assume they don't need to lodge a return, particularly young people or those who've only worked part of the year. In many cases, they're actually owed a refund. Most people who earned income need to lodge. Otherwise, you must notify the ATO you don't need to lodge. Mistake 2. Forgetting income sources. The ATO receives data from banks, employers, government agencies, and investment platforms. If you forget to include interest from a savings account, income from a side hustle, or earnings from rideshare driving, the ATO likely already knows. Declare everything. Mistake 3. Claiming deductions without records. The most common reason the ATO reviews a return is unsupported deductions. Keep every receipt. A simple digital folder where you save receipts and bills throughout the year makes tax time significantly easier and protects you if the ATO ever asks questions. Mistake 4. Claiming private expenses as work expenses. Your morning coffee is not a work expense. Your gym membership is not a work expense, unless you're a personal trainer. The ATO specifically watches for this. The deduction must directly relate to earning your income. Mistake 5. Missing the deadline. If you lodge late without a registered tax agent, the ATO may apply failure to lodge penalties, which increase the longer you delay. Put the deadline, 31st October 2026, in your calendar now. Nobody likes getting a tax bill instead of a refund. Here's how to avoid it. The most common cause is having multiple income sources. If you have 2 jobs, your second employer may not be withholding enough tax because they don't know about the first job. When you start a second job, ask your employer to withhold at a higher rate or speak to a tax agent about the right amount. Investment income is another common cause. Income from dividends, bank interest, or rental income may not be fully covered by PAYG withholding. Even though some income, like dividends, may include tax credits, there can still be a shortfall that results in a tax bill. What you can do instead: if you expect additional income, you can adjust your withholding or make voluntary tax payments during the year. This helps smooth out your tax position and avoid a large bill at lodgement. The goal is simple: no surprises at tax time. Understand what you earn, understand what tax applies, and make sure the right amount is being withheld throughout the year. That's the 2025 to 26 Australian tax return, explained simply, without the jargon. Remember, the ATO's website at ato.gov.au is one of the best free resources available. It's detailed, updated every financial year, and covers almost every situation. If you're ever unsure about a specific deduction, that's the first place to check. Links to MyGov and the ATO are in the description below. If this video helped you feel more prepared for tax time 2026, subscribe to ClearCents AU, new Australian finance videos every week, breaking down the things that actually affect your wallet. In the next video, we'll break down the tax deductions Australians can legally claim in 2026, and the common claims most people completely overlook.